This is Risk SA TV. We're at the second day of the PSG annual conference at Sun City. I'm joined now by Michael Falk, international consultant for Focus Consulting. Thank you very much for joining us.
Thanks for inviting me to join you. Thank you.
Michael has been sharing with us today insights on how human behavior and how emotions impact decision-making around finances, and what advisors need to be aware of in thinking about their clients in this way. Just to tap into the theme of your talk today, you were talking about the rise of kind of robo-advisors and people moving away from active advice and active management. You say that in a sense this needn't be a threat for advisors. In fact, anyone who is a good, skilled professional in this space might even see it as an opportunity. Tell us a little bit more about that.
Happy to. So, first of all, it's really not moving away from active advice as much as moving away from active management. So the challenge with active management is beating their passive benchmarks, net of fees. We know this is a challenge, we may get into that later, but the active advice is where they can really make a difference. Let's be honest, when we talk about human behavior, what motivates or warranties the decisions that any of us make with any of those challenging decisions, it's not about necessarily what's right for us. It's about what feels good. And I talked about that. It's really about affect instead of logic and good decision making. That doesn't mean that we're flawed in how we make decisions. It just means that we're human. And as a result, we do things that are not in our best interest. The stock market is falling. What feels good is get me the heck out of there. I don't want to stay anymore. But what we know is that's the exact worst time for you to sell out. Maybe you even should add money. So the counsel that can be given to that person at that point in time is simply just stay the course. They don't have to do anything fancy. Just help coach them into why that's not a good idea, and if they're willing to extend trust, that they will actually feel better about the decision, hopefully not in the too distant future.
So, I mean, at the moment, the whole issue of remuneration is huge in South Africa,
Yeah.
And that kind of the toss-up between whether it is commission-based or fee-based remuneration. What are your thoughts around this?
Well, first of all, what someone gets paid, I try not to reach into other people's pockets too often. You get in trouble doing that typically. Fees versus commissions. Well, what we know with commissions, there are inherent conflicts because you're getting paid for selling a product. That doesn't mean the person is conflicted. It just means there's inherent conflict. So as we move to fees, we could argue that we're removing some of the conflicts out of the decision-making process. Good. But now we still have to talk about the types of fees. Is it a fee based upon assets under management like 1% management fee? Or is it fees along an hourly wage like a lawyer might get paid, like an accountant might get paid? And we have to now have a proper dialogue about what is the right fee for the service. What is the value being brought by the advisor, which I could argue with good advisors can be immense. But we have to ask the question, if they're doing fundamentally the same work each and every year, year in, year out, should the fee still be based on a percentage of AUM, or should it more be like a professional fee like we might think about for attorneys and accountants? And that's really where the dialogue has to go. The challenge is having clients sign off on that dialogue at the same point because they've been passively paying fees because it's been automatically coming out of the assets under management. Well, when you shift and where they might have to actually write a check to pay for their fees, they're probably going to be a bit grumpy about that. They're probably not going to like that. So they may prefer a method that maybe is less in their best interest because of how it feels. And that goes back to affect about behavior again.
Yes, so on this topic of behavior and the affect, you spoke a little bit about how in creating value and allowing clients to see the value in advice, the key thing is that ultimately clients don't need to beat benchmarks, they need to achieve their goals. Yeah. What do, and you shared wonderful insights on behavior and how people respond to stimuli in almost quite random ways. What are the key things that advisors need to understand about their clients from a behavioral point of view?
Well, what they have to understand is that for the vast majority of clients, investing is not sport. They don't do this for pure enjoyment. And to the extent they might ever want to go that direction, what we say is maybe go to Sun City and go gambling. Go to a casino instead. And with your serious money, properly plan. At the end of the day, if they want to retire at a certain age, if they want to be able to send their children to university, if they need to buy a bigger house because they've outgrown the older home, I don't care what the goal is. Success is them getting to where they want to go. Now, we might say that if they invest a certain way, they'll get there faster, but they also may never get there if the investments go the other direction. We can suggest that if they invest a certain way, they may get there with less savings on their own part. Well, think about that now. So they're expecting something else to do the work for them instead of them saving more. Listen, I get it. We all get it. At the end of the day, putting money away for future consumption is a trade-off. Do we really want to lower how we're living today for some tomorrow, and we don't even know if we're going to be around? So again, people are not irrational. They're not silly. They're making decisions that are very human. Where the advisor comes into play is the advisor can help coach them into making better decisions. And if they really want to achieve those goals, they do want to retire at some point. They want their children to go to university so they get a better lives. These are serious goals. Do you really want to roll the dice with your investments to do this, to achieve, versus planning and saying, you know, we'll get there in time. We're just going to do this the right way.
Coming back a little bit to the active-passive debate, there was talk today around the fact that 25% of, or sorry, only 25% of active managers are able to beat the index or beat the market. So I know that a lot of your work is done consulting with fund managers around how they do their decision-making processes. Do you feel that this is the effect of errors in decision-making which can be improved? And when people are looking to choose active fund managers, what kinds of decision-making, what kind of fund manager should they be choosing?
Well, first of all, they have to choose fund managers who are working in a space where they have a higher probability of success. So the 25% figure that you cited is very true across a lot of markets around the world. But it's not true in all markets across the world, in all asset classes. So the first thing you might think of is, where do we want to use active management? Maybe in those spaces where it's easier to add value. And where do we want to use passive? Maybe in those areas where it's tougher to provide value. We do work with asset management teams. Specifically, I team up with the analysts and the PMs to help their decision-making processes. What I can tell you is there are techniques they can use to improve their decision-making. And they're not overly difficult. But as the old saying goes, the first step is to admit you have a problem. So to the extent that they can understand where they're falling into behavioral traps in terms of their decision-making, once they know that, we can build workarounds so they can sidestep the traps and ultimately make better decisions. What I can tell you is active management does have value, but you have to pick your spots. And you also have to be sensitive to doing it right, doing it in markets that where maybe you raise your chance of success, doing it with active managers who don't charge excessively high fees, doing it with managers who are really serious about the business, meaning as they start managing more and more money and their portfolios are becoming bloated, it's harder for them to win with more assets under management. So why don't we look for good stewards, money managers that either have an amount of money under management which is still easy for them to service and manage, or maybe we don't use them. So there are some little things that we or investors or advisors can use as techniques where they don't have to actually kind of crawl inside the head of a money manager to try and find out, do they really have a clue or not? And is it a good place to invest my money? I personally happen to think both have merit, but if you're going to use active management, you have to know when and how to use it properly. It's not evergreen. It's not good at all times.